This is Intermediate Accounting, Chapter 16. Now that we've discussed and studied basic stockholders' equity in Chapter 15, we're going to work through dilutive securities and earnings per share, where things get really complicated and messy for stockholders and corporations. This chapter takes Chapter 15 and puts it on turbo speed, so it takes all what you learned and then adds the really fun, squirrely little details. Make sure to review your slide notes to your right, and then go ahead and grab from the Moodle shell all the extra resources, the earnings per share information, and the big problem set to work through on the Excel spreadsheet on the big EPS example at the end. Let's get started. First, a question. Should companies report things like stock options, convertible securities, preferred stock as liabilities or equity? The problem is that many of these squirrely little things have characteristics of both liabilities and equity. So the question is, where do you put them on the balance sheet? Kind of confusing. So convertible securities, as well as stock options and stock warrants, preferred stock, etc., these things are all called dilutive securities because upon their exercise, they could reduce, therefore dilute earnings per share. First, convertible debt. Convertible bonds can be converted or changed into other corporate securities during some specified period after issuance. It combines the benefits of a bond, i.e. principal and interest, with the privilege of exchanging it for stock if the investor, i.e. the creditor, would like to. The investors who purchase convertible bonds want the security of a bond holding with a guaranteed interest in principal, and then the added choice of possibly converting it in the future if the stock significantly appreciates. So why do we issue convertible debt? Well, to raise equity capital without giving up more ownership control than necessary, or to basically obtain common stock financing at cheaper rates. For example, if a company issues a specified number of convertible bonds, they can be converted into a smaller number of shares than might have had to be issued on the market for the same value. And also, not all the shares might have to be converted. And if these bonds are not converted, then the worst thing is the company then has to go ahead and pay back the debt. But if they are converted, the company has enjoyed the benefit of having this equity all along, except no voting rights, and then the added benefit of not paying back the debt. So when you handle obtaining common stock financing at cheaper rates, because companies can only issue debts at various interest rates unless they attach a convertible component, the investors might be willing to accept a lower interest rate as well. Convertible debt has the benefits of both. Okay, accounting for convertible debt. Well, first things first. At issuance, this is nothing but debt with a right to possibly change over in the future, which means you record convertible debt as a straight, boring debt issue, just like the last chapter, just like Chapter 14, with any discount or premium amortized over the life of the debt. So, nothing is recorded as equity. Everything is straight out as bonds, debit cash for the amount received, the present value, credit to bonds payable of the par value, and a debit or credit to discount or premium if one exists. Then over time, you amortize the bonds to the maturity date of any discount or premium that results, and then if they're converted, you deal with that then. So here we go. $4 million par value, 7% convertible bonds at $99 for cash. Okay, if the bonds had not included the conversion feature, they would have sold for $95. Journal entry. Well, debit cash for the 99% at $4 million. And you say, whoa. Why the 99%? Because that is still their value. You don't give a crap if they would have sold, because guess what? They didn't. You sold them at 99. Debit cash for 99% of $4 million. Credit your bonds payable for $4 million, and the difference is a debit required, a discount on bonds payable, remember, the contra liability. Now, in regards to convertible debt, if and when the bonds are actually converted from a liability to an equity, there is some accounting work that needs to be done. If converting the bonds into other securities, like common stock, companies use the book value method to record the conversion, which means you record the book value
As in, you kill the debt, you kill any discount or premium, and you create the same value of stock and paid-in capital in excess of par that the value is on the books of your debt. As a result, you exchange basically debt for equity, and the book value is the number, and there is no gain or loss recognized upon the conversion. I repeat, no gain or loss. And whether a premium or discount exists, you just kill it, make it go away, and you just move things over at the same value. Now, as a result, you can't make money, you can't lose money on conversion. Let's look at Moore Corporation. They had outstanding 2,000 bonds, each worth $1,000 apiece, that are convertible into 50 shares of $10 par value common stock. Bonds are converted December 31st when the unamortized discount is $30,000 and the market price is $21 a share. Convert the bonds. Well, first things first, kill the bonds. Make them go away. Debit bonds to kill them. Now, a discount is a normal what balance? Okay, a discount is normally a debit. What do? You kill it with a credit. Okay, go ahead and kill it, and then create common stock, and the common stock will always be equal to number of shares issued times the par. Well, if you have 2,000 bonds, and each is convertible into 50 shares, 2,000 times 50 is 100,000 new shares at $10 a piece. That's $1 million of common stock. And notice, you don't balance. So what do? You plug the other 970,000 to paid-in capital in excess of par. Notice, no gain, no loss exists. You are simply moving money from debt to equity, and the extra value you shove into paid-in capital. That is because the common stock account will always be equal to number of shares issued times the par. Cool, huh?
Now, sometimes the issuer wants to encourage prompt conversion to reduce interest costs, to improve debt to equity, whatever reason. The issuer then, the debtor, says, here's some additional consideration called a sweetener. And a sweetener is simply an expense of the current period. So, go ahead and have a sweetener. Same journal entry, same company as right before, except we're paying a sweetener of $70,000. Journal entry at conversion, same entry as before, exact same, except now we have a debit to debt conversion expense. Normal expense, normal cost of business, credit cash, all is well, and I'm done. Now, retiring convertible debt. Okay, when you're issuing convertible bonds, you use straight debt issues. No problem. Issuing companies then do not put anything about additional paid-in capital or conversion, whatever, if it's straight debt or convertible debt when it's issued. Therefore, when we retire convertible debt, if we're retiring debt and they don't convert it, it still gets treated as debt. So this goes back to Chapter 14, Long-Term Debt, Basic Retirement. So kill the debt, the bonds payable, kill the related premium or discount, pay out the cash, and if you need another entry to balance it, a gain or loss, normal, just like Chapter 14. If it is convertible debt and it was never converted, retire it just like straight, boring, normal debt. If you have convertible preferred stock, you simply have the right to convert your preferred stock into common stock, which means the funds are already in equity. Easy peasy. So no gain, no loss. You simply use the book value method and kill all the preferred stock with all the related additional paid-in capital preferred stock and create common stock and any additional paid-in capital on the common stock size. No problem. But if the common stock issued is greater than the value of the preferred stock, you simply then debit retained earnings for the difference. So basically, if your preferred stock is so small a value that create much more common, add it into retained earnings. No problem. But it really isn't that common, so you don't need to worry about it. So here's some convertible preferred stock. Gall issued 2,000 shares, $10 par value per share. Common stock upon conversion of 1,000 shares at $50 par value preferred stock. Okay. Preferred stock was originally issued at $60 a share. So you're going to have some preferred stock and some additional paid-in capital preferred stock. Common stock is trading at 26 bucks. What do? Okay, first things first, kill the preferred. Debit your preferred stock for $50,000 or 1,000 shares at 50 bucks a piece. Also, kill the paid-in capital on the preferred stock, which is the difference of the $10 additional market value per share at 1,000 bucks, or 60 minus 50 times 1,000. Create your common stock, 2,000 shares at $10 par value apiece, 20,000. Dump the rest into paid-in capital common stock. You do not give a flying care. Ignore entirely the cost of the common stock currently trading. You don't care. 26 bucks is just ridiculous. Ignore it, doesn't matter. You simply balance it out and move on.
A quiz. Use your books, use your notes, click the Start Quiz button to proceed. Good luck.
Now, stock warrants are certificates that entitle the holder to acquire certain shares of stock or certain number of shares of stock at a certain price within a stated period. So they do this to make the security prettier, more attractive, to provide a preemptive right to purchase common stock first, and provide compensation to executives and employees. Warrants then, if they are exercised, become common stock and are therefore dilutive and actually reduce the overall value of earnings per share, just like convertible securities. But when warrants are actually exercised, the holder has to buy the shares. They're buying them at a specified price. So this is there to do a good work, but it also involves some fun accounting. Now, stock warrants are often issued with other securities. These are basically long-term options then to buy common stock at a fixed price. These are within a life of 10 years, but they could even be 20 or 10 or even perpetual. When warrants are detachable, they can be detached or separated from the stock and traded as a separate security. If the stock warrant can be detachable and traded separately, the company then allocates the proceeds between the two securities based on fair market values. And you do the proportional method or the incremental method that you learned in Chapter 15. Okay, the proportional method. We simply allocate the proceeds of various securities based on their fair market value, and we know both. We simply then determine the value of the bonds, or whatever we have, and the warrants, and split it out. So, and it's the same way as a lump sum sale of securities. With the incremental method, we simply allocate the proceeds based on whatever we know. If we know the bonds, we go with the bonds. If we know the warrants, we go with the warrant. We go with the common stock, we go with common stock. Whatever. You simply take what you know, lump that into the overall value, and plug the rest. Same manner as last chapter.
So here with Margolf, they issued 2,000 bonds that were worth $1,000 each at 101. Each bond was issued with one detachable stock warrant, and after issuance, the bonds were selling in the market at 98 and the warrants at a market value of 40 bucks. Use the proportional method to record the issuance of bonds and the warrants. The reason we use the proportional method here is because we know the value of both the bonds and the warrants. So what do? We prorate that value and crunch it out. So here, you've got 2,000 bonds worth $1,000 each, and you know that after issuance, the bonds were selling at 98. So 2,000 bonds times 1,000, okay, for dollars, is $2 million par value times 98%, which is $1.96 million. That is their true value after their happy little detachment. The warrants, 2,000 warrants at 40, is a value of $80,000. $80,000 plus the $1,960,000 is a total of $2,040,000. That's the total value. So what do? You prorate, and you take your $1,960,000 and you divide it by your $2,040,000, and you say, it's about roughly, let's go with, doing the math right here, it is about 0.960784, roughly 96%, but not exactly, okay? And the warrants are 80,000 of 2,040,000, so 80,000 divided by $2.40 million is a little over 4%. Now, if I were you, I'd keep the exact percents in here. Otherwise, you get your numbers all squirreled up. So, take your 0.960784, times that by the amount of cash that walked in your door, which is going to be $2,020,000 or 101% of $2 million. And that is your value of your bonds. Okay, the $1,940,784 rounded. And you say, but the bonds have a par value of $2 million. Yeah, there's their market value, so subtract off your happy little par value of $2 million, and that gives you your discount, okay, of about $59,215, okay, if math is right in my head. Now, the warrants, you take your $2,020,000 times the roughly 4%, and you find out they're worth about $79,218. So what do? You put it in a journal entry. So it looks like this. Cash comes in of $2,020,000. The discount on bonds payable is your $59,216-ish rounded. That's a debit because remember, a normal discount is a contra to your bonds payable. It drives it down. Bonds payable will always go on your books at $2 million because it's always at par. And there's your paid-in capital of stock warrants, $79,216. So that's how we do the proportional method. Now, if we assume then in the second part of the illustration that each warrant can be exercised to buy one share of common stock at a $5 par value, okay, and you can buy it for $30 a share. If the investors went ahead and did exercise all 2,000 warrants, how do we handle that? Well, cash walks in, 2,000 warrants at $30 a share, so cash walks in of $60,000. Paid-in capital stock warrants, since it was a full amount of $79,216, goes away. That paid-in capital account no longer exists because, in effect, you are actually killing it to create real stock. Common stock will be created at 2,000 shares, because you have 2,000 warrants, at $5 a piece, so that's $10,000, and then you plug the rest to paid-in capital. Remember, common stock will always be equal to the number of shares issued times the par. Therefore, you plug it all into paid-in capital in excess of par, and there you go. Same problem, except now we're doing the incremental method. And with the incremental method, we actually only know one piece of the puzzle. We know they issued the warrants attached to the bonds, but we don't know the market value of the warrants after they were detached. Okay, so what do? We go with what we know. We know they issued 2,000 bonds for $1,000 each at 98%, and 2,000 times $1,000 times 0.98 is $1,960,000, and that's all we know. So we assume that that is the value of the bonds, and which means, as a result, if that's $1,960,000 and the bonds par value are $40, well, that means the discount on bonds is $40,000. So what do? Cash comes in of $2,020,000. We knew that. 101 of the $2 million, Discount on bonds payable of 40. You go ahead and bonds payable always go on the books at par for $2 million, and the plug is the rest to paid-in capital stock warrants. And that's the incremental method.
Now, when you had detachable warrants, you really had two different securities, a debt or an equity security plus the warrant to buy common stock. If they are detachable, you have two securities and you separate them out on your books. You record them separately. If they are non-detachable, you cannot split them. You can't allocate the proceeds. Therefore, you dump all of them in as debt. Now, we all know a big right for existing stockholders is the preemptive right, the privilege to buy newly issued shares in proportion to their holdings to maintain their current ownership percentage. This prevents the dilution of their voting rights without their consent. Now, rights and warrants also pose an issue there. They're normally less than the current market value as another way of providing benefits to stockholders. But companies then make a memorandum entry when they issue rights to existing stockholders. There's no formal entry because they have not yet issued stock or received any cash. They're just the right to buy. If the holders exercise the stock rights and the cash payment is involved, then you book the entry. So until the warrant is exercised, if you give them as right to subscribe to additional shares, there is no entry.
A quiz. Use your books, use your notes, click the Start Quiz button to proceed. Good luck.
Okay, I mentioned earlier that a stock option, which is a type of stock warrant, can arise in stock compensation plans to pay and motivate employees. This stock option then gives key employees, the upper echelons, the option to purchase common stock at a given price over an extended period of time. So these are when executives say they have a compensation of $400 million. Most of it's really in stock warrants. Now, because effective compensation programs are there to help motivate employees, provide bonuses and compensation based on performance, maximize after-tax benefits, retain employees, recruit new talent, and use performance criteria, a stock-based compensation plan can be a very important part of compensation for your employees. The fun part here, though, about using stock warrants and stock options for stock compensation is determining the value of the compensation that the employee received, because the employee may or may not actually exercise the options. So under FASB, companies then recognize the compensation costs using the fair value method. And then companies base the accounting for the cost of employee services on the fair value of the compensation paid, presumed then to be a measure of the value of the services rendered. Okay, so accounting for stock compensation. Your first job is to determine the compensation expense and over how many periods to allocate that expense. To determine the compensation expense under the fair value method, companies then crunch out the total compensation expense based on the fair value options expected to vest on the date they grant the options to the employees, therefore called the grant date. Then, the company then recognizes the compensation expense in the periods in which the employees perform the service, called the service period. And unless otherwise specified, unless specifically stated, the service period is the vesting period, the time between the grant and the vesting dates. So if you look at your stuff, you say, okay, I am providing the grant date on January the 1 of 2015. And it vests on December 31st of 2018. That's all of 15, all of 16, all of 17, all of 18. That's a 4-year compensation expense period.
Now, to do a stock compensation, the best way to handle it is to start at the beginning and work your way all the way through. So November the 1st of 16, the stockholders of Serial Company approve a plan that grants the company's 5 executives, so the big head honchos, the options to purchase 2,000 shares each. So 5 executives, 2,000 shares apiece, total of 10,000 shares of the company's $1 par value common stock. The options are granted on January 1 of 17, and they can exercise the options at any time within the next 10 years. The option price per share is $60, and the market price of the shares when they are granted is $70 per share. Under the fair value method, the company crunches out the total compensation expense by applying an acceptable fair market value option pricing model, and that determines the total compensation expense of $220,000. Now, November the 1st, they approve the plan, and they grant the options November the 1st, and they're going to be for 2 years, and we'll see why on the next slide. Start your basic entry. Assume the expected period of benefit is for 2 years starting with the grant date. How do they record the transactions? Well, at the end of each of the 2 years, so the end of 17 and the end of 18, they're going to go ahead and do the same exact entry twice. Now, we know the total value is $220,000, so per year is $110,000. Debit compensation expense for $110,000, credit, paid in capital, stock options for $110,000. And you'll do that same entry on December 31st of 17 and December 31st of 2018. Now, if they exercise 2,000 of the 10,000 options, or therefore 20%, okay, and they exercise them 3 years and 5 months after the date of grant, how do you record the exercise? Well, first things first. By exercising stock options, the executives are paying in cash $60 per share $60 per share times 2,000 shares. And they're going to create stock options. They're going to create common stock out of that and kill the stock options. So first, cash walks in of $120,000, which is $60 a share times 2,000 options. Check. Now your paid-in capital stock options are going to go away as well, but not the full amount. We valued that as a total of $220,000. Just take 20% of that away, so $44,000 is going to go away. Now, 2,000 options is 2,000 shares. 2,000 shares, par value $1. Credit common stock for 2,000. Remember, that's because common stock account will always be equal to the number of shares issued times the par. And you plug the rest to paid-in capital in excess of par for common stock. Just plug it and you are good to go. And that's exercising options. Now, by the end, they decide not to exercise the remaining 80% of those stock options. So what do? They go away. There were a total of $220,000 worth of stock options. We exercised 20%, which leaves 80% of its value left. 220,000 times 80% is 176. So you say, okay, paid-in capital stock options, go away. They're gone. That paid-in capital no longer exists. Why? Because you debited it to kill it. And you credit paid-in capital expired stock options, and that paid-in capital is pretty much permanently there on the books. It can't really go anywhere because it was attached to stock options that are no longer available. So it just becomes another paid-in capital account, expired stock options for $176,000. You'll notice that was the last entry in the previous page. This is because the companies do not adjust compensation expense upon expiration of the options. The compensation was still the value of getting that choice. Just because the employee doesn't exercise the choice does not mean the value didn't exist. Now, the only way, if an employee forfeits a stock option because they fail to satisfy the service requirement, i.e. they quit, the company then adjusts the estimate of the compensation expense recorded in the current period as a change in estimate, but does not go back and change anything in the past. Okay? So even if they don't use a stock option, doesn't matter. You just simply say whatever compensation expense was what it was, I ignore it. It's only if the employee forfeits the option by quitting, basically, that you adjust the compensation expense. And that's only for the current year.
Companies can also use restricted stock to compensate employees. Restricted stock plans transfer a specified number of shares of stock to employees subject to the agreement that the shares cannot be sold, transferred, or pledged to anyone until they are vested. Now, the beauty of this is the stock is never really completely worthless, even if the stock price rises and falls. Generally, it doesn't dilute equity that much because restricted stock transfers are not as nearly as big as stock dividends. And employees feel better about themselves and their work because it associates their incentives with the company incentives. Difference in accounting is that restricted stock is first provided as unearned compensation. It is not compensation expense. Once it vests, then we do compensation expense with a debit, and you credit unearned compensation. But if the employees leave, well then no problem, no big deal, you never booked it anyway. ESPPs, or employee stock purchase plans, allow all employees to purchase stock at a discounted price for a specified period of time, usually pretty short. The company then uses these plans to secure equity capital or encourage widespread ownership of common stock among employees. This was a big thing that Enron did, by the way. These plans are often considered to be part of employee compensation unless all three things are satisfied. If substantially all full-time employees may participate on an equitable basis, the discount for the market is small, and the plan offers no substantive option feature. If they satisfy all three, they are then not employee compensation. Okay? So if the discount is like 5% or less, it's not compensation because it's just the cost the company avoids issuing shares in public offering. So if these three categories are met, these three items, it's not employee compensation, just an extra benefit. Disclosures are a huge issue for stock compensation. So if companies have pretty much any share-based payment arrangements, they have to disclose the nature and extent of the arrangements, the effect on the income statement of that compensation cost, how they crunched out the fair market value of the goods received, the services received, the fair value of the equity instruments granted, etc., and the cash flow. So if you do this, a lot of disclosures, make sure you have it totally detailed, vetted by the lawyers and the auditors.
A quiz. Use your books, use your notes, click the Start Quiz button to proceed. Good luck.
Earnings per share is a huge and vitally important part of this chapter. I mean, it is the big one. So companies have to report per share amounts for the effects of a number of items. Now, you learned basic earnings per share way back in Chapter 4 about the income statement. Earnings per share is there to indicate the income earned by each share of common stock, even though they don't receive it. And companies have to report earnings per share only for common stock. So your income statement then has this intermediate components of income, like income from continuing operations, loss from discontinued, or gains, or extraordinary items, then net income. You have to disclose each and every one of those separately. Now, things get a little exciting and slightly hateful when you have dilutive securities. In dealing with earnings per share, your first goal is to understand your capital structure. If your corporation's capital structure is simple, it consists of only common stock or includes no potentially dilutive securities. Okay, or only common and preferred stock, no dilutive securities. A capital structure is complex if potentially dilutive securities are present. And dilutive securities means that dilutive is the ability to influence the earnings per share negatively. If any security can dilute or decrease the value of earnings per share, you have to report it. If it is anti-dilutive, making it so you could increase earnings per share, you do not report it. First, basic earnings per share you learn in Chapter 4. Earnings per share is crunched as net income minus preferred dividends, basically earnings for common stockholders, net income divided by minus preferred dividends, and then divide that whole thing by the weighted average number of shares outstanding. Whether these preferred dividends are cumulative or not, or even declared or not, you still have to lay them out, okay? Net income is easy, preferred dividends, no problem. Weighted average number of shares, things can get ugly. These are the weighted average number of shares outstanding during the period. And therefore, if you buy back shares or issue shares during the period, that affects the number of shares outstanding. So you weight these number of shares by the fraction of the period in which they are outstanding. So basically, you get a prorated amount to find out how many whole shares are outstanding for the year. If you have stock dividends or stock splits, then you have to go through and restate the shares outstanding before the split so you can crunch it properly. So that's because the stock dividend or stock split don't change the total investment, but it does screw with the number of shares hanging out. So if you have these, you have to restate them as if the stock split or stock dividend occurred from the get-go and restate them all for the year for the calculation.
So here we have Bergman Company that has the following changes in common stock during a period. Now to crunch weighted average shares outstanding, what you're really doing is just weighting them by time. So you say, okay, January 1, beginning amounts, I've got 100,000 shares, and those 100,000 shares exist from January all the way to March 1st, so January and February, or 2 months out of 12. On March the 1st, we issued another 20,000 shares for cash, and those 120,000 shares then exist from March the 1st to June the 1, so March, April, May, 3 months out of 12. On June the 1st, we issue a stock dividend for 50%, which is another 60,000 shares, and those 180,000 shares exist from June the 1st through June, July, August, September, October, November, all the way to November 1st. But stock dividends are a little bit funky. So we'll look at that on the next page. And then November the 1st, you issued 30,000 more shares for cash, and those were outstanding for 2 months. Now, we tear it apart and look at how this works. To make sure that things aren't unfair and squirrely, we actually, for all stock dividends and stock splits, have to go back to the beginning of the year and actually restate them as if they had occurred all along. So knowing that we have multiple different shares outstanding, the first thing I would do is take my stock split, which means my stock dividend, knowing I had that, and go back and restate all the number of shares until we reach that point. Meaning, from January 1 to March the 1st, the 2 months, we had 100,000 shares outstanding, but we also issued a 50% stock dividend on June the 1. So I take my 100,000 shares, and I would say, okay, 100,000 times 1.5 in order to convert those to the stock dividend amount, 150,000, and then multiply that by 2 divided by 12. Therefore, 2 months out of the 12 months in a year, and you get a weighted amount of shares of 25,000. March 1 to June the 1, 120,000 shares. Restate for the stock dividend at 1.5, so that's 180,000. And then those were outstanding for 3 months out of 12, so times 3 divided by 12, 45,000. Now you're at June 1 when the stock dividend actually occurred, so you no longer have to restate backwards. Now you're at June 1, November 1st, so that's 180,000 shares times 5 divided by 12 because they're outstanding from June, July, August, September, and October, or 75,000. And finally, November the 1st to the 31st, and that's 210,000 outstanding shares times 2 divided by 12, 35,000. Then the final weight is to add up that 25, 45, 75, and 35,000 to get 180,000, and you would use that number as your denominator in earnings per share. A quiz. Use your books, use your notes, click the Start Quiz button to proceed. Good luck.
Okay, as I mentioned previously, the complex capital structure results when the organization has something that is possibly dilutive. And these things could be converted into common stock, convertible securities, stock options, stock warrants, other rights, whatever. These are any single thing that upon conversion or exercise could dilute or make smaller the earnings per share. And you have to report both on their financial statements. Okay, crunching out diluted earnings per share. It's similar to basic earnings per share, but it has to include then all the possible effects of potential dilutive common shares. Everything that was outstanding during the period. The easiest way to crunch earnings per share, diluted earnings per share, is to start out with basic earnings per share and then take into account all the impact of convertibles, options, warrants, etc. Don't try and go cheap and screw around and guess at it. You start out with basic, and then you add in or subtract off other impacts. Companies do not report diluted earnings per share if the securities are anti-dilutive, meaning that the securities, upon conversion or exercise, would increase EPS, earnings per share, or reduce the loss per share. So you only go through and report dilutive earnings per share, because the point is to give the stockholders the worst case scenario as if every single thing was dilutive. Okay? And so you do not report anti-dilutive securities because conversion is not likely to happen. So how do you handle dilutive earnings per share? Okay, start out on each different specific item. Okay? Measure out the dilutive effects of the conversion on earnings per share using the if converted method, i.e., this assumes that A, the conversion of the securities occurred at the beginning of the period or the time of issuance if it occurred during the period, so the first day, that everybody changed over on the first day, and B, that you can kill all interest expense net of or after tax. So if you have convertible debt, You get to pretend it happened at the beginning of the period and kill the interest. So it could be a beneficial experience. Okay? Now, with stock options and warrants, use your treasury stock method. And what happens here is that a company includes in diluted earnings per share all the stock options and warrants outstanding unless they're anti-dilutive. Companies then use treasury stock method, and then you assume that the company exercises the options or warrants at the beginning of the year or the date of issuance if later, and then you use all that money that you got from the stock options and warrants to buy back common stock for the treasury. Okay? And we go through this whole complicated gyration as if this is what happened. If the exercise price is lower than the market price of the stock, then the proceeds, of course, are not enough to buy back all the shares. The company then would add the incremental shares remaining to the weighted average number of shares outstanding to crunch out this method, which we'll do in a second.
Now this page is quick. This is my personal summation that I have built about how to do all the basic and dilutive earnings per share. In fact, every time I do diluted EPS, this is what I do. And I encourage you to do the same. Draw your little grid thing out so you don't forget any things. You have 4 columns: basic, convertible debt, convertible preferred stock, and stock options. And what I've done is I showed you the name of the column at the top above the red, and then the big black line is the dividing sign between numerators and denominators. Start always and forever with basic. Always start with basic before you do anything in dilutive. And you have the normal numerator and denominator. Net income minus preferred dividends divided by weighted average common stock shares outstanding. Normal thing, start with basic. Then you add whatever columns you need to the side to make sure that you have all your stuff. Convertible debt. The convertible debt, because you no longer have to pay your happy little interest costs, you get to add back the after-tax impact of converting that debt from debt to equity, and you add that after-tax impact to the numerator, and you divide by, or add to the denominator, the number of new common shares, okay? And that's because if you convert debt to stock, you don't have to pay back that interest cost. But remember, it's always the after-tax impact, okay? That's because, we learned from chapter 14, interest is tax deductible. So, what do? You find out the value of the interest, and then you multiply it by 1 minus the tax rate. So the interest expense times 1 minus the tax rate. With convertible preferred stock, you'd say, okay, well now you've already subtracted off preferred dividends, right, in your basic. So you're simply going to add back those preferred dividends you already calculated. That's because if you convert preferred stock into common stock, you don't have to pay preferred dividends. So you simply add back to that numerator what you've already taken out on the basic earnings per share calculation. And so the numerator, that part actually, the preferred dividends part, cancels itself out. And then you add the new shares to the denominator. Finally, with stock options, we are going to pretend like we take all the money from the stock options that we received or the warrants exercised and buy back as many shares as we possibly can as treasury stock. So what do? Is we say, all right, what is the value of the cash we're going to receive for all those new shares? Multiply it out. And then what we're going to do is we're going to buy back all the shares we can at the market price. And then the difference of those two amounts is my denominator on that one. Notice in stock options, there is no numerator. Stock options will always and forever be dilutive. Always dilutive. But convertible debt and convertible preferred stock may not be dilutive. They may be anti-dilutive. So you have to check those against your basic earnings per share for both the individual calculations. Now, to do all of this, the easiest way for me to show this all to you is to actually do an example. Let's take a look. So here we have from your book P16-8. Now, in the Moodle shell, I have built for you a blank template as well as putting the answer key in there as well. So you can go through and review all of this at your leisure. You have net income of $1.2 million. You've got 7% convertible bonds issued at par, and each bond is convertible into 30 shares of common stock worth $2 million in your book. That would be par. So 7% convertible at 7%, that is your interest rate. Convertible says you can convert debt to equity, and they're issued at par, so no discount premium, phew. And each bond is convertible into 30 shares of common stock. So you take your $2 million of bonds, divided by $1,000 a bond, and you say, oh, I have 2,000 bonds hanging out, waiting around. 2,000 bonds can be converted into 30 shares. That's how you find your denominator. You also have 6% convertible cumulative preferred stock, $100 par value. Each share is convertible into 3 shares of common stock with a value of $4 million. Okay, break it apart. That 6% is your dividend, your preferred dividend, and that 6% is on par. And then you can actually find out number of shares, and off you go. So these preferred stocks can be converted, and their par value of $100. 6% of par value, that's $6 per share that you get as a dividend. There's $4 million worth of stock. So what do? You take your $4 million, and because the number of shares issued will always be equal to, number of shares issued times the par will always be equal to the total value in the account. $4 million divided by 100 for par is 40,000 shares right now of cumulative preferred stock. Knowing they can be each converted into 3 shares, you times by 3, and that's your new shares. Common stock right now has a $10 par value. There's $6 million in the books of common stock. So you take your $6 million divided by 10 bucks, and you find out you have 600,000 common stock shares to begin with. Cool. 40% tax rate, and you have an average market price of $25 a share during the year. You need that because you have stock options in the paragraph below. There were no changes during 2018 in the number of common shares, few, or preferred shares, few, or convertible bonds, few, and there is no treasury stock. But the company also has common stock options granted in a prior year to purchase 75,000 shares of common stock at 20 bucks a share. Your mission, should you choose to accept it, is to crunch out basic and dilutive earnings per share. Let's take a look. All right, let's start piece by piece on this problem. Now, before I do anything, and before I go wild and crazy on dilutive earnings per share, start with basic. Always and forever start with basic. And I'm not going to crunch any numbers, so I get everything all designed and in there so I know what I'm dealing with. First, net income, $1.2 million. And then I've got to crunch out my preferred dividends. Now, my preferred dividends are going to be my amount of my dividend per preferred share times the number of preferred shares. And we already established from the previous slide that our par value was $100 per share for preferred stock, and they were 6% preferred dividend. Okay, so $100 times 6%, and you'll simply multiply that by the number of shares you have, which you know the total is $4 million, and their par value 100, so take 4 million divided by 100. So you have $100 par value times 6%, you get a $6 per share preferred dividend, times the $4 million of preferred stock divided by 100, and that gives you your preferred dividends. Weighted average shares outstanding for basic happen to be your $6 million of common stock divided by par value per share of 10. That is because the number of shares issued times the par will be equal to the value in that account. Okay, that's basic. Don't crunch anything yet, just lay out the numbers. Convertible debt. You know that you had $2 million of bonds that had a 7% annual amount of interest. So $2 million times 7% gives you the before tax amount of your interest. You need to use the after tax amount. So it's $2 million times 7% times 1 minus the 0.4, or 1 minus 40%, which is the after tax, which will convert it from before tax to after tax amount. Okay? New shares, $2 million of bonds divided by $1,000 per bond gives you 2,000 total bonds you're dealing with, and each bond can be converted into 30 shares. So 2 million divided by 1,000 is 2,000 bonds times 30 bucks 30 shares of bond, and there you go. Preferred stock, you already crunched out that dividend, which is $100 par value times 6%, or $6 a share, times the $4 million of value in the account divided by $100 par to find the number of shares involved. And then you know that each share is convertible into a set number of new shares. In fact, each share is convertible into three common shares. So $4 million in the account divided by 100 gives you number of preferred shares. Multiply that by 3 because that's how many common shares you're going to get. Stock options numerator will always be 0. And your denominator is your number of new common shares. You know that you have 75,000 options. Check. That is how many new shares are going to go out in the world. But you are going to take that $75,000 shares, and they're going to give you $20 a piece for that. So 75,000 times the 20, you're going to get cash of $1.5 million. And then what you're going to do with that cash is you're going to divide it by the number of shares that you could buy back, which your average market price is $25. So that's going to give you the ability to buy back 60,000 shares. And 75,000 new shares going out, you buy back 60,000 shares, you'll be able to have a net out the door new shares of 15,000 shares. Okay, we've laid out all the math. Now, simplify and crunch. Net income, 1.2. Preferred dividends, subtract those off of a total of $240,000. Divided by your weighted average shares outstanding, 600,000. Convertible debt, you crunch into a numerator of 84,000 and a denominator of 60,000. New shares, okay? I'm just crunching out the math I laid out above. Preferred dividends, you're going to add back 240,000 and you will create 120,000 new shares. And then $0 for the stock option numerator and new shares coming in will be 15,000 for the stock options. Now, before you do your final crunching, if I were you, I would check for dilution. The ability of these things should all be dilutive, as in make your earnings per share smaller. But if they are anti-dilutive, you should not report them. So you have to check each and every single different piece in order to check if it is dilutive or anti-dilutive. And how you would do that is you would do the basic earnings per share plus that one little area, either of the three options, but only the one at a time. What I mean is, for convertible debt, for example, your anti-dilutive check is you would do your $1.2 million net income, minus out preferred dividends of $240,000, add back the convertible debt of $84,000, and you would divide it by the total of your weighted average shares outstanding for common, 600,000, plus the 60,000 new shares you're creating under convertible debt. And by crunching all of that out, 1.2 plus 200 minus 240,000 plus 84,000 divided by the 660,000, you would get 1.58. Now, leave it alone, 1.58, okay? And then crunch out preferred stock, 1.2 million minus 240,000. Oh, add back preferred stock, 240,000. Take your 600,000 divided by 120,000 and you get 1.67. Okay. Stock options. Crunch that bad boy. Okay. 1.2 million minus 240,000, again for preferred dividends, plus 0 as the numerator, divided by 615,000, you get 1.56. Then what you do is you compare each and every one of those to your basic earnings per share. Okay? And your basic earnings per share, you crunched it as 1.60, or 1.2 million minus 240,000 divided by 600,000. Therefore, convertible debt is dilutive. So go ahead and declare it, show it. The preferred stock is anti-dilutive. Ignore it. And your stock options are also dilutive, all because those are smaller than basic earnings per share. So your final dilutive earnings per share would be your $1.2 million minus the $240,000 plus the $84,000 plus the 0 divided by the $600,000 plus the $60,000 plus the $15,000. And that is dilutive earnings per share, and you have crunched the most complicated problem you're ever going to see on dilutive earnings per share in practice or on the CPA exam, though real life could be a little more complicated than that.
Now, in business combinations, an acquirer can promise to issue additional shares. These are called contingent shares, and under certain conditions, these occur. Sometimes the company issues contingent shares because of passage of time or because the attainment of a certain earnings level or market price level, etc. So they exist, they're there, you might see them in the future. Again, with anti-dilution, if a company has to go through and look at all these different items, if any of these potentially dilutive securities are individually anti-dilutive, you exclude them and ignore them from earnings per share. For earnings per share presentation and disclosure, the organization has to show per share amounts for income from continuing operations, income from discontinued operations, income before extraordinary items, and net income. Now, these per share amounts for discontinued operations or specific ordinary items are presented on the face of the income statement or your note disclosures. Then, the organization must show earnings per share amounts for all periods presented. And if you have a complex capital structure, you have to provide sufficient note disclosures to adequately explain and present how those items look on both basic and dilutive earnings per share. The list on your screen is for complex capital structures and the dual presentation of EPS, all these additional disclosures in note form. So describing the rights and privileges of the securities outstanding. 2, reconcile numerators and denominators of the basic and diluted earnings per share computations and your income and share amounts, anything that affects EPS. So basically what I did on the example problem. You have to show all the effect given preferred dividends in determining income available to common stock for basic and securities that could potentially dilute basic EPS that were not included because they were anti-dilutive right now. And you got to show the effect of conversions subsequent to year end, but before you issuing statements. So basically everything you can think of, declare it. This quick little graphic is to show you the simple capital structure. So you crunch out income applicable to common stock, weighted average outstanding, there you go. And remember, income applicable to common stock is net income minus preferred dividends. Here's a quick look, same graphic except we've expanded it to complex capital structure. Basic earnings per share becomes dilutive, and you have to include your convertible securities, options, warrant, and any contingent issue agreements. So right there you have also a formula that I've given you. That's the same thing I did on chapter 42, on slide 42, but for me, it's easier to see it spread out in what I do per item. This is really important stuff. You can't blow it off.
A quiz. Use your books, use your notes, click the Start Quiz button to proceed. Good luck.